Thousands of jobs lost. Household wealth falls to the lowest level in a decade. But wait, where did the money go? There's no secret group in the mountains burning stacks of cash every time the market dips. In fact, during most recessions, governments print more money. So when it's wiped off the stock market, sliced in half, and totally lost, where is it actually going? The money wasn't there in the first place. If you see money as something solid and fixed, numbers in your bank account that stay the same no matter what happens in the world, then hearing trillions of dollars wiped off the stock market sounds like someone vacuumed up the cash and it vanished. But that's because we're confusing three things: money, price, and value. Money is a unit, a way to measure what we believe something is worth. Value is a belief, an idea of what something is worth, and that belief can change. Price is the agreement between buyer and seller, the number that expresses value using money. We focus on the number. I've got 10. But those 10 only matter if people still believe they're worth something. Money is valuable because we all agree it is. That belief allows money to store value over time. In this system, money isn't really there. It's a perception of what we think something is worth. And perception can change fast, especially when everyone's perception shifts at the same time. When that happens, people stop trusting markets, banks, companies, and even each other. That's what changes value. You didn't lose cash, you lost confidence. This lost confidence isn't limited to stocks. Your house could suffer too. Your property could suddenly be worth 15% less because someone in your area sold low, resetting the belief system. Economists call this mark-to-market valuation. What people are willing to pay becomes the new reality, no matter what it was worth last year. The value was there because people believed in the future of the company or product. If something threatens that future, belief changes. For example, in January 2025, NVIDIA was the most valuable company in the world. China's DeepSeek was released, and analysts flagged it as a threat to NVIDIA's core business. On January 27th, NVIDIA's stock plummeted 17%, a $589 billion single-day loss. By January 28th, investors reassessed, and the stock rebounded nearly 9%. By February 20th, it was almost back to pre-DeepSeek levels. This shows how quickly belief in value can disappear and return. There's nothing tangible about it. The value was never printed. It was a number on a screen, an agreement between buyers and sellers. When belief disappears, the value disappears with it. But because it's in all of our heads, it's real. The money stops moving as fast. In a healthy economy, money moves quickly. In a recession, it slows down. Velocity of money: how many times a dollar is used in a year to buy things? Growing economy: $1 changes hands 5 to 7 times a year. Recession: as low as 1.5 times. What used to look like this? You spend $20 at a restaurant, pays the chef, buys groceries, store pays supplier. Now looks like this. You keep the $20 in your account. It sits. The restaurant never gets it. The chef's hours are cut. The grocery store sells less. The supplier slows production. Money has two roles: stored value, savings, assets. Medium of exchange, spending, investing. When the second role breaks down, everything slows. It gets put into passive holding zones. People park money in savings accounts, low interest, safe. Government bonds, low risk, low return. Money market funds, slightly better than savings, still safe. But there's a problem: inflation. If inflation is 3.6% and your savings account pays 0.4%, you're losing purchasing power every day. To the person who buys the dip. When people panic sell stocks, crypto, or real estate, prices tank. The person who sells at a loss transfers wealth to whoever buys low. Fear moves faster than logic. People sell because they're scared, even if waiting would recover value. Not all assets bounce back. Some worry they're holding the one that won't recover. Into hard assets and safe havens, money flows into gold, up 78% during 2008 recession. Farmland, stable, always needed. Art, rare pieces hold value. For example, during the 2008 crisis, Yves Saint Laurent's art collection sold for $483 million. Big assets that have lost value. Wealthy investors buy distressed apartment buildings, struggling businesses, discounted company shares. Examples: Apple, Amazon, Berkshire Hathaway, private equity firms like Blackstone. The capital gravity zone. The ultra-wealthy, top 0.01%, grow wealth through ownership, not income. Examples: Walton family, Walmart, 1997, $27 billion. 2024, $430 billion, after multiple recessions. Hermès family, luxury fashion. This is where most of the money stops.